Okay, so I want to just kind of start going through this. And as I mentioned before, the biggest difference between this and a mini merger model is we have full financials. Here are the consolidated financials. This is what we're going to build dependent on the individual companies. This is the acquirer, the acquiring business. And notice I've stacked the schedules: income statement, above balance sheet, above cash flow statement, depreciation schedule, working capital schedule, debt schedule. And the same with the target. Now this is, we're going to look at just a template. These are not real companies. Just to give you the high level as to what the procedure is. And then we'll do a case. So for now, I just want to make sure you're comfortable with the steps. And the first step is to lay out the assumptions. The assumptions are very similar to what we had done in the mini merger model. Again, just to kind of clarify where we're supposed to go with this. And it's first, the acquired stock is trading at 60, the target at 5. And we're assuming a 25% premium. So we want to figure out how much we're paying for the business based on the premium. So we're going to pay a 25% premium above the $5 stock price, right? So the purchase price per share is going to be the $5 times, in parentheses, 1 plus 25%, or $6.30, right? To get the purchase price, we need to multiply that by the number of shares outstanding. Where do we get that? But I mean in the model. Yeah, well. Yeah, whose? Target. Target. What's number? What count of shares? Fully diluted. So we'll go to the target financials. We'll pull 2013 diluted shares. And so the target purchase price is a product of the two, 6.3 times 650. And what I'm going to do is I'm going to divide this by 1,000. I can divide it at the purchase price, or I'll divide it when I pull in the shares. It's actually the shares whose units are off from the rest of the data. If you notice at the top left, and you might see this in some models when we spoke about this at Walmart, the units are presented in thousands, except for the number of shares. A lot of times companies just report the shares in actual numbers because they don't want to round. So we'll have to divide the number of shares to get to the like units. And so if that's the purchase price, for the uses, pull in the purchase price. I've just given you transaction fees 100. In the case study, we'll talk about estimating transaction fees a little bit better. But what do we know about the target debt? How do we think of it? Huh?
Private or public?
Is it private or public? The company. Public. Right. It's got shares, it's got stock price. And do we? How do we know? Interesting. We just spoke about it. You got to look at the covenants, right? You don't know. If it's private, you have a better indication based on if the purchase price is an enterprise value or an equity value. In this case, you don't know, but I'm giving you the thought process and the way to think about it, because you might be asked these types of questions in an interview, and they're going to probe your knowledge of it. So you have to think about first, is it private or is it public? If it's private, it depends on where the purchase price is coming from. We spoke about that. We'll do that. We'll drill into that in LBOs. If it's public, you got to look into the covenants. In the case study, we'll see that there are clues you can read into to figure it out. Office Depot, Office Max is a good one, so we'll look at that. For now, let's assume we have to pay it down, which means what? Do we include it or exclude it into the uses? We do include it if we have to pay it down. We're going to raise more funds to pay that down. We will pull it in from the 2014 net debt, all the short-term debts plus long-term debts minus cash. It's going to come in from the target financials, 2013, balance sheet, long-term debt, minus cash. Say again? Short-term plus long-term minus cash. 38.2. Okay. Alt equals sums a total. Anybody have a flash stick? Flash stick? Check. Do you guys want this model? Play around with? Do you guys have Excel? So you're not staring at the wall. It's okay.
I don't have a computer though.
Oh, I thought you had a laptop right there.
No.
Okay. You have nothing to save this into? I can email it to you.
I'm alright, I can see it. Yeah, don't mind trying to see it.
Thank you. Okay, let me save it. Thanks, Jack. In the meantime, I'm going to save this down. And then we need to figure out the uses. Now, the uses there, it was given 50-50 for now. And we did that so we can run some sensitivity and some scenarios on this.
To go back to the question earlier about whether or not you pay down the net debt,
Yes.
wouldn't it always be beneficial to pay down that net debt that's to refinance this way? So use that, it's not even kind of, they're a new company, right? So you might end up getting a better rate.
Well, yeah, if you can get a better rate, yes, but you may not always get a better rate. And you know, it depends on those factors. It is, in theory, it's more than likely if you consolidate a larger mass amount of debt with yours and you have more assets, it's probably better to refinance because you probably will get a better rate. Yeah, there are some events where you might not though, and that's what you need to look for. Here we go. Let me just save this as 10/27/15. Okay. Yes. Say it again.
I want to check
Which formula?
that's for
Yeah, short-term debt plus long-term debt minus cash. Okay, so we're going to assume that the sources are 50% of the total uses. And remember, it's important that one of these is a hard code and the other is dependent on that hard code. This is just 100 minus this percentage, as opposed to having two hard-coded variables so that we can run sensitivities on just the one variable in a data table. Okay. And for the debt, it's also going to be equal to that 50% times the total uses. And these are our core assumptions that can be used to make. What? Can you just Jack? Okay, well, we will deal with the goodwill when it's time to do the balance sheet. Any questions? Okay. Now let's go to the consolidated financials. The consolidated financials are similar to what we have in the acquire and target. This is a simplified analysis, so we'll get through it quite relatively quickly, but it's income statement above, then underneath the cash flow statement. Then we have balance sheet adjustments. This is going to be a new schedule we're going to talk about. This gets to AJ's question about how to merge the balance sheet. Then we have the actual balance sheet, depreciation, debt, working capital schedules. We'll merge it all together. Okay, so we just care about projections. First projected year. Okay, so we're going to look at the revenue is going to be simply a sum of the acquire and target revenues. Acquire revenue plus target revenue. I just care about the total revenue at the bottom, just like we did in the mini analysis. Add acquire plus target to the right. Real simple. If you have time while you're doing that, I'm going to calculate the growth. If you don't have time for the growth, then do it later at home. It's not key to the rest of the analysis yet. So another major difference that you should be starting to see about a merger model is these models usually don't come with projections and scenarios. The projections and the scenarios are made up in the individual tabs that are being merged, as opposed to a leveraged buyout or an operating model where you're making your own projections. This is just the sum. We're also adding cost of goods sold. So again, this is a template. It's nice and easy that the line items are matching up, but we'll see in real situations where the line items don't match up. One company might have 4 cost of goods sold line items, another one won't. So when we do the Office Depot Office Max, we'll look into those things. But this is just high level. Cost of goods sold, acquire, plus target. And I don't know why the formatting is off here, but yeah, I gotta fix this, make it black, unitalicized, 1 decimal. Okay, with a comma. And you can calculate the metric of COGS as a percentage of revenue. Again, if you don't get to that, don't worry about it too much. Just make sure you're calculating gross profit. I always calculate the total lines, gross profit, EBITDA, EBIT, net income. Always calculate those top down. Don't do acquire plus target for those, because then you won't capture any adjustments that might be made above. Yes. I know, I like being when we're downstairs better. Is that better? And we can calculate the margins. Again, don't worry about it if you don't have the margins in there. You can do that at home. Any questions so far? Research and development. So all our operating expenses, again, OPEX, acquire plus target. So I'm going to take research and development, acquire research and development, plus target research and development. Again, it's nice here because we've made the line items match up exactly. If they don't, we'll have to kind of look into that further. Copy that to the right. And because those lines match exactly, you can just take this row and copy it underneath to add together the SG&A and to add together other. You can just copy it down. It's adding, when the rows line up, it's going to be adding the same rows. That's what you want. And you can do your margins. So I did that very quickly. Take a few minutes. To copy all of that. And you can add to get OPEX and I'll take a couple minutes. We now have our first adjustment under OPEX, which is cost savings. There's a couple of ways to look at cost savings. We talked about the complexity of projecting it. Again, when we have a real case, we can look at that in more detail, but from a mechanical perspective, it's often looked at as a percentage of the SG&A. How much of SG&A are you going to reduce? You don't need 2 headquarter buildings, right? For example. So for simplicity, we're just going to look at it as a percentage of SG&A. That percentage, I believe, was given in the assumptions tab. So in cell G20, I'm going to link this in from the assumptions G20, 3% cost savings. And so I'm basically saying I'm going to 3% of the combined SG&A will be a reduction. So I'm going to link this as a negative to show that it's going to reduce. So I'm going to have minus 3% times the SG&A. 57.7. That's going to be the reduction. I'm going to make sure that I've anchored the reference to that 3% so that I can copy to the right without shifting the reference. And I'll copy everything to the right. Yes?
Anytime we've ever done these merger models, we've always kind of been given what the cost synergies will be. In the real world, how do we come up with this?
We'll talk about it in the case. Yeah, we talked about it before. Yeah, it's something that's very difficult to project. Yeah, let's get to the case. We'll talk about it. I definitely did spend quite some time on it when we talk about the mini merger model, and it's a tough thing. But let's save it for when we have something tangible to focus on. Otherwise, it'll give it more meaning. Yeah. Just make sure. Yeah, we'll cover it for sure. Yeah. So other stuff, it gets a little bit kind of hairy here, and we'll see this also when we see more line items. When you think about things that are other, so in this case, equity and earnings of unconsolidated affiliates, what is that? What does that mean? We'll talk about how to project that. Or what is it? You guys remember?
Minority interest.
Yeah, and it's an investment that this company has in somebody else, right? So if this company if you own, less than 20, if you own a stock, right, less than 20%, you get a dividend. If you own 20.1% or more, but not over 50%, you are a minority interest holder. They could now call it non-controlling interest holder, which means you don't necessarily get a dividend per se. You now have other rights. You have a board seat. You can make influential decisions, possibly, and you receive a percentage of the net income. So if this company has between 20 and 50% roughly ownership in another business, it receives a percentage of that net income as a distribution. That's other income. It's the equity that's received in the earnings that they own of unconsolidated affiliates. If it's a consolidated affiliate, that means they own it more than 50%. And if you own more than 50%, then it's a merger. Then you own all of it. You consolidate the financials. So if you think about that, and we're basically looking at the acquirer's earnings in unconsolidated affiliates and the targets. Do you combine them? What do you do? What happens to the acquirer's, let's start there, the acquirer's equity and earnings of unconsolidated affiliates in a merger scenario? Remains unchanged. Their stake isn't touched. They might own a 5% or 25% interest in something else just because they've merged with somebody that has nothing to do with it. What about the target's interest? Why?
It depends on what you're acquiring. So if you acquire the target, including its minority interest in the business, then it's consolidated with everything else. But if you're just acquiring the target, not including those minority interests, you should be taking it out.
It depends, yeah. It kind of depends on that. What are you, and actually, in my experience at least, first of all, you're not buying that out. Or this is separate. This is not the interest that's in the target company. It's the other investments that the target company owns. And so you have to step back and think about, as part of this merger process, is it choosing to divest those interests? So you got to do some diligence in that. That's the way you think about it. So, and that's why we'll look at things like in the Office Depot and Office Max case, even though that's a big merger, when you look into the proxy and the forms and all that, it's actually 3 different mergers, and it's 3 different mergers because it has to do other side negotiations before it's ready for the major merger. Things like divesting assets and pension funds, and so you got to drill into that. For now, let's assume it's going to hold on to it, and that's a separate transaction, and usually they do. Usually they assume if they're divesting things that the target company is that the acquired company is not interested in, it will look at it in separate side transactions. So for now, let's just assume this is acquire plus target. But to generalize this, anything that's other income. So we didn't talk about other income in the high level. You're adding together everything about the business except for items dealing with target, debt, target. As a general rule, in the template, I want to apply general rules for other income. Would we add acquire plus target? Would we keep it at acquire only, meaning eliminating target stuff? What would you think as a general rule? And this is kind of a matter of opinion.
Kind of depends on how core it is to the operation.
It depends how core it is to the operations. How can you establish how core it is to the operations? Knowing about what we talked about other income.
Probably see where they have it on the income statement.
Yeah, when you say where, yeah, if it's above EBITDA, we talked about this in valuation. At least as an analyst, if the individual companies had modeled it above EBITDA, they're implying that it's part of the operations. Given that we understand as analysts, EBITDA is part of it, we create EBITDA, right? EBITDA is not something that's GAAP, it's usually laid out in GAAP in an income statement. So usually as a clue, if you're dealing with models and they've put these other line items above EBITDA, then I would assume it's core to the operations, you're adding acquire plus target. If it's under EBITDA, then you want to take a second look at it. So we talked about equity and earnings above consolidated affiliates, and generally, is it above EBITDA or not? And that depends. So you want to start to look at these things. So a lot of these other line items could be managed separately. And when we evolve from just the basic template into the actual case, we're going to think about how is the acquisition managed? And how the acquisition is managed is going to help us determine whether a lot of these line items are going to be acquire plus target, acquire only, or just projected independently. There's three ways to manage an acquisition. And so there's a lot of generalizations that can be made, right? Always revenues acquire plus target. COGS is acquire plus target. But some of these other line items, you don't know. But generally, if it's part of operations, since operations is what you are acquiring, the general rule is it's acquire plus target. So for now, let's take equity and earnings of consolidated affiliates and have it be acquire plus target. We'll save digging into detail for the template. But it's important to at least start to think about those types of analyses. I'm going to copy that to the right. And so our EBITDA is the gross profit minus the costs minus the cost savings, which actually increases cost savings, minus other income, and you should have 13,244.7. No, because the cost savings increase.
No, I know, but minus other income.
Well, it depends. I mean, if other income is in there, it depends on how you build it. I put anything that's an expense as a negative. I'm sorry, as a positive. Anything that's an expense is a positive. So you're going to reverse the logic and make income positive here?
Mm-hmm.
I don't recommend doing that. But if you do it that way, sure.
So you did the gross profit minus the total
Depends.
expenses minus.
I think we get this, yeah.
Minus the cost savings because you put it as negative.
Yeah, that's the way. To me, it's easier to, everything is revenue minus. I know some people say, all right, well, when you go to other income now, income is positive, and you change it. To me, it's confusing. Every expense is shown as a negative. Every expense is shown as a positive. So I show any income as a negative, right? Cost savings is basically an income. It's money coming in now. We can do margin. And then we have depreciation and intangible asset amortization. These are items we will leave out for now. Depreciation will come from the depreciation schedule. Intangible asset amortization we will project when we talk about the balance sheet. So for now, but we can still plug in the formula for EBIT, which is EBITDA minus those line items. Oops. and can calculate percentage. Right? You guys have that? Interest expense, interest income. Again, we're going to leave that empty. That's going to come from the debt schedule. But we'll assume net interest expense is a sum of the two. So we can put that formula in as interest expense, whoops, plus interest income. And the EBT is going to be the EBIT minus the interest expense. The number's not going to change yet. And then we can calculate the margin on that. So it's not going to change your numbers, but you have the formulas in place so that once we link things in, this will kind of start to flow. Start to think about how this is different than in the mini merger. In the mini model, we had interest expense was acquire only plus the new debt raised times the rate. That's all going to come from the debt schedule because the debt schedule is going to have the new debt balance in there. The higher debt balance, we're going to calculate interest that way. The new debt balance that's going to be pulled into the debt schedule is already going to be just the acquirer debt balance. It's going to exclude the target debt balance. It's going to add the new debt balance. We're going to calculate interest off of that, right? It's going to be it's doing basically the same thing, but just in a more detailed schedule. Income tax expense. So for income taxes, this gets a little tricky too. We'll look at this more in the case. What about the target's taxes? The target might have a tax rate that's different than the acquirer's. In this case, it's the same, so it's easy. Are you, when you acquire the target, are the target operations going to be running now under the acquirer's tax structure? This is a diligence question. Maybe yes, maybe no. Is it a blend? We usually assume it's going to be under the acquirer's tax structure. We'll look at Office Depot, Office Max. We'll talk in a little bit more detail about how to look into that. But usually as a default, we'll just take it from the acquirer. So let's do that for now. Pull in the acquirer's tax rate, and we're going to recalculate the taxes, of course, so we can capture the adjustments. Pulling in the acquirer's tax rate.
Is the tax rate not from the assumptions now?
I would pull it from the acquirer. Is there a tax rate there?
Yeah.
I'd pull it from the acquirer. We'll use that tax rate for things like tax step-ups and capital gains and things like that. Don't anchor that. And copy this to the right. And so we have net income is the EBT minus the taxes. Someone stuck out there?
Slide.
That's 15 minutes. 15 minute Huh? He's working away. He's done. Yeah. Okay. Now we have another issue that we'll look into in more detail. Non-recurring events. What about non-recurring events? These are other items. Is it acquire only, acquire plus target? How do we think about that? Yes, Sam.
Acquire only.
John.
Acquire only.
Why?
I mean, just because you're not going to take into account the targets how occur, that's not going to happen. So there's really pointless in putting them in the evaluation.
Will they happen? That's the way to think about it. Sammy, were you going to say something to that? Or?
I was going to say something basically the same thing, but wouldn't we just project it to be zero with close to not
Well, I mean, that's one thing. Usually, from a projection standpoint, you usually project them as zero because we're not going to assume that they're going to happen or they're non-occurring. But if they were to happen.
Unless the acquirer would like to dispose maybe some of the assets.
Yeah, actually, very good point. Yeah. And actually, that's exactly the case in Office Depot, Office Max. So you want to look into them individually. Yeah, from a high level, usually they're projected zero anyway, so they're almost a non-issue. If they are projected, though, you want to think about what are they, and are they really, so from the acquirer perspective, you'll bring them in, of course. The acquirer stays. There's nothing about just because you're acquiring a target that's going to change about the acquirer's model. The acquirer's model stays. You're always bringing the acquirers. To your guys' point, you're probably projected as zero anyway. From the target's perspective, you want to think about, have they been projected? If they have, is there any reason why, because we're acquiring it, it's going to change, right? So this is where we're going to start to get into a little bit more detail about what I just mentioned. There are three ways to manage an acquisition. It's either, and this will help us result in thinking about, are these one-off line items going to be acquire only, acquire plus target, or reprojecting from scratch? And the three ways you would manage an acquisition is dependent on what the acquiring company is looking for in the target. So if we're like, UPS, or let's take the power company, where it's largely an acquisition of assets. Let's look at UPS, where we're one distribution business in Manhattan acquiring like another distribution business in Brooklyn, and we really only care about the customers and the deliveries and the drivers. Right? I don't care about anything else about the business's operations. In that perspective, any of these one-off line items that are not core to the business operations, we're probably going to look to wipe out. Right? Anything that's other change in accounting principle, other line item based on write-up of pension funds, things that you're probably going to eliminate anyway, you will not bring in those line items if it's not core to the operations. That's one way to manage an acquisition. Another way to manage acquisition is think about like a conglomerate, and maybe a better way to think about that, like a Procter & Gamble, acquiring maybe a business that it's not really in a clothing company or something that it hasn't really any like operations in. And that type of acquisition, it's going to acquire the business. It's probably going to set it up as an operating subsidiary that's probably going to operate largely independently. It's not going to consolidate. It's going to consolidate operations from a financial standpoint, but not from a management and legal standpoint. In that case, probably a lot of those one-off line items, it might keep in place. It's going to say, you know what? I acquired the business because I want this product in my portfolio. The business has been operating well. I'm going to let them operate it how it's been operating as usual. I'm not going to really touch the operations. If that's the case, a lot of these one-off line items will be acquire plus target. So think about that. Like a private equity fund. You're a fund. You're going to acquire this business. I'm going to keep it operating the way it is. So one way of managing an acquisition is you really like the product, you just want the operations, you want the operating assets, I'm going to wipe out everything else. Then one-off line items will go wiped out. Another way is I'm going to acquire this business, I'm going to let them run the business as it's been operating. I won't wipe out those line items. The line items are going to be acquire plus target. The third way is this is a consolidation. Company A plus B is going to be company C. Both are going to be merged together. It's going to be an entirely new entity. We looked at American Airlines, Time Warner. You're going to, in these cases, a lot of times you'll just rebuild and reproject the model from scratch. You'll merge historical operations and re-merge build from scratch. So that we will slowly start to see there are three ways to manage an acquisition. And the way the acquisition is managed is going to help us determine whether these one-off items will truly be acquire plus target, acquire only, or reprojected from scratch. So in this case, we're taking the example of, which is largely the case, we just care about the company's core operations. We don't care about anything else. That's why we assumed other income was above EBITDA, part of core operations. It'll be acquire plus target. Any of these non-recurring events we don't care about, acquire only. Now, Tago's point, which is very important, we'll see this in Office Depot, Office Max. The one exception is if one of these non-occurring events was dealing with assets. Assets is core to the operations. You might want to reconsider that, no matter how the acquisition is acquired. Because in any acquisition case, you definitely want the assets. So if the one-off item is dealing with the company's core operating assets, which is what you want to acquire, you might want to keep the line item. Okay, so in our projections, we're going to take acquire only, acquire financials, discontinued operations. It's 0 anyway, so it doesn't really matter, but just to show you the procedure. And I'm going to copy this to the right and down. Whoops. Whatever. And I'm going to make it black and add it together. And the net income is the net income before non-occurring events minus non-occurring events. And then we have income attributable to minority interests. And let me just, in the new model, it's now called non-controlling interests. They've changed GAAP, the way you label it. How does this differ from the above equity and earnings of unconsolidated affiliates?
Owned over 20%, so
it's something that the company owns less than that 50% stake. So therefore, at this point, we would see the flow through of the net income that you wouldn't show throughout the rest of the statements.
Mm-hmm.
Kind of like the reverse of what we get with minority interest. That minority interest is included throughout.
This is minority interest.
That's minority interest or equity stakes?
Yeah, well, we're talking.
No, my fault. I misinterpreted. I was looking as if it was an investment in another company that was less than.
Is this minority interest people owned in our company?
Yes. Yeah. So this is the opposite. Maybe that's what you're trying to say. This is the opposite of the equity and earnings among consolidated affiliates. This is equity and earnings among consolidated affiliates is we, let's say we have this company, we own a percentage in somebody else, they give us money every year, right? This is somebody else owns a percentage in us, we got to give them, they're our stakeholder. So thinking about acquire and target, what do we do with this? What about the acquirer's equity and earnings of non-controlling interest? The acquirer's investment income attributable to non-controlling interests. Do we keep that? Do we wipe that out? What do we do?
So I guess for the acquirer, you keep it.
Yep, the acquirer, it's unchanged. This is somebody owns a stake in us. We're buying companies. We're doing share buybacks. That doesn't change the nature of our investors in that respect. What about the target? Yes.
The target, it would sort of depend on how much of the business we're buying. So if we're buying 100% of the business, then we're obviously buying off those minority interests.
Yep.
So they would no longer be included.
Yep.
But if we're only buying a portion that they don't own, then we'd have to bring them with.
Yeah, so in the target company, if we're buying out all the shareholders, we're buying out the public shareholders, we're also buying out the non-controlling shareholders. We're buying out everybody. So the target's interest is gone. We're buying everything dealing with the target company, and we're taking on everything about the target company except for items dealing with target debt and target equity. This is target equity. So let's assume, and this is a template case, but we got to dig into the detail with the real cases that we'll do next week. Let's assume that it's just the acquirer only. But what will change is, even though that the percent that the minority owner hasn't changed, the net income has changed. So we're buying a target business, we have more net income, we might have to pay them more out. So we're going to have to reproject this. So I'm going to pull in the percent minority interest from the old acquirer tab, So we had a 4% interest holder. Oh, 0%. All right. Then it's 0%, but let's pull it in anyway. And just to show you how it's done, we recalculate by taking the new net income times the percentage. And then we're almost there. Now, we got to think the same thing about the dividends. What about the dividends? How do the dividends change?
For the target, if you're buying out the company in total, then you don't have to pay dividends to shareholders.
Right. Target dividends gone. Target dividends gone. What about the acquirer?
From one perspective, I think we keep the same rate of business as
Yep.
used to be.
We keep this. Yep. Will the number change? Why? New shares.
Yeah, so you add in
New shares. So the dividends calculated is the same idea as in a standalone. It's the number of share, the number of basic shares times the price paid per share. The difference is we probably have more shares outstanding. Why do we have more shares outstanding? Because we've raised new shares, presumably to fund the acquisition. So it's the same idea, but we're going to pull in the dividends paid per share from the acquirer. Let's do that now. So we're going to assume that the acquirer, if the acquirer has been paying 8 cents per share, there's nothing to say that it's changing its dividend payment plan just because it made an acquisition. If it's going to change its payment plan, it's going to do that separately. This is a different idea. What will change, though, is the amount of dividends paid if there's a lot of new shareholders out there. So we're going to multiply this 8 cents by the new shares outstanding. And so we'll stop here and we'll deal with that tomorrow. We need to first, before we can go further, calculate the new number of shares outstanding and build down to net income. So we'll deal with that tomorrow. We'll finish this, get into the cash flow statement, and if we have time, start to get into the balance sheet adjustments.